South African households have taken a knock from high interest rates, inflation, and the lack of employment opportunities, all of which have been exacerbated by load shedding. While this environment does not bode well for households, there are reasons to be optimistic, as inflation is expected to ease back within the target range in the latter part of the year, and that will take some pressure off households and reduce the need for further interest rate increases. Though I do expect the South African Reserve Bank to keep interest rates high for longer than anticipated. As we have seen in the OMSIM results, while the macro environment remains adverse, South Africans have remained resilient. There are some who continue to save, and that is positive. However, not surprisingly, OMSIM results indicate that confidence in the South African economy has dipped to 27%. This sense of pessimism is pervasive across the economy and unfortunately one of the reasons for its poor performance. It is a chicken and egg situation though. People are only likely to be more optimistic when they see signs of improvement. South African households should be prudent in how they handle finances, and commitment to debt should be thought of carefully, especially major commitments such as property or a vehicle purchase. It all depends on your goal for investing and your time horizon. Your approach to investing should be determined by your goal, not the external environment. If, for example, you are saving for retirement many years away, you will need good exposure to equity markets which should provide capital growth over the long term, but which are volatile in the short term. However, if you have a short-term goal, such as putting money aside as a deposit for your first home, you may want to invest in a safer investment vehicle that is not as volatile as stocks. Because of higher interest rates, the return on these types of investments is currently better. Times of greatest risk and uncertainty are usually the best time to invest because others are selling in a panic. If you can step in and buy during such unsettling times, you can improve the long-term return. A monthly contribution into a pension fund or other savings vehicle is the easiest way of doing this, as you will automatically buy in months when the market is down. But again, it depends on your goals. If you have a short-term investment horizon, play it safe. A diversified portfolio should include a mix of local and global investments, but the exact split between the various asset classes depends on the investor's goal and investment horizon. It also depends on where the best valuations are on offer. When one asset class is cheaper than usual, it makes sense to increase exposure on a tactical basis, and currently South African assets are attractive precisely because everyone is so pessimistic. A lot of the bad news on the local economy is already priced into local markets. The main factor holding the local economy back is load shedding. And here the outlook is much better, largely because of massive increase in public sector investment in electricity generation. Some of the other infrastructure bottlenecks will also be addressed through increased private investment, but that will take longer. Consumer spending should also pick up a bit going into next year as inflation eases. Unfortunately, other problems such as crime and crumbling municipal service delivery are increasingly headwinds for economic activity, and there is little sign of improvement. On balance, however, the outlook is better, but it is far from great, and South Africa remains an economy where 2% growth counts as a good outcome.